That minute of calm, that moment of relaxation is about to get much more expensive in the United States. New tariffs imposed on coffee from Brazil have been announced by President Trump.
Tonight, we're taking a closer look at President Trump's 50% tariff on Brazil and what that means for the cost of coffee.
Yeah, Brazil is the world's largest coffee exporter. So Marcelino Benito explains how that tax could hit American wallets.
President Donald Trump has lifted 40% tariffs on Brazilian beef, coffee, cocoa, and other imports from Brazil. The tariffs had driven up prices after Brazil prosecuted its former pro-Trump president. Brazil supplies about a third of U.S. coffee. The administration also removed tariffs on other agricultural products to ease grocery costs.
There is a shift happening in the global coffee trade right now, and most people are reading it the wrong way. They think this is just another tariff story, another Trump headline, another fight with another country over another commodity. But coffee is not just another commodity. Coffee is one of the world's most globally traded agricultural products, and Brazil is not just another exporter. Reuters reported that Brazil is the world's largest coffee grower, that the United States is the world's largest consumer, and that roughly a third of the coffee used in the U.S. comes from Brazil. That means when Washington hits Brazilian coffee with tariffs, it is not nudging a side market. It is shaking one of the core supply relationships in the global coffee system. And that is exactly what happened. In July 2025, Trump announced a 50% tariff on Brazilian imports starting August 1st. Reuters reported that the measure rattled the global coffee market immediately and raised the prospect of even higher coffee prices in the United States because traders warned that a 50% tariff could halt normal Brazilian coffee flows into the U.S. market. That matters because commodity markets do not only run on price, they run on reliability. They run on whether contracts make sense, whether shipping flows remain predictable, whether importers can plan inventory, and whether exporters trust that a market will still be worth serving by the time the cargo lands. Once tariffs jump like that, coffee stops being just a product moving from Brazil to the US. It becomes a risk problem. And when trade turns into a risk problem, supply chains start looking for the least volatile route, not just the highest price. That is where Canada enters the story. Now, Canada does not grow coffee. It cannot. So if we are being analytically honest, Canada did not replace the US as a producer, and it did not replace the US as the single most important end consumer market overnight. But that is not the real point. The real point is that in a moment when the US made itself look less reliable, Canada became more valuable as a buyer. And in fragile commodity systems, that matters. Reuters reported that after the tariffs took effect, Brazilian coffee exports to the U.S. fell sharply. U.S. imports of Brazilian coffee fell to 301,099 bags in August 2025, from 562,723 bags a year earlier. And the head of Sea Cafe later said exports to the U.S. had fallen 46% in August, and then another 20% through mid-September. Reuters also reported that Brazil redirected more coffee to other markets, including Colombia, Italy, and the UK. That sequence is important. America tried to pressure Brazil. Brazil did not simply wait for America to calm down. Brazil adapted. That is how global trade works now. When a major buyer becomes politically volatile, exporters do not treat that as background noise. They start reducing concentration risk. That is the deeper Tradeconomics point here. The U.S. tariff did not just raise prices, it weakened trust. And once trust weakens, the map starts to move. Not always dramatically, not always with one giant announcement, often quietly, contract by contract, shipment by shipment, buyer by buyer. That is exactly why this story is bigger than coffee. Because what Brazil learned here is something a lot of exporters are learning at the same time. Market size is not enough if the market becomes politically unstable. And what Canada offered, by contrast, was not dominance. It was predictability. That is the strongest part to quality trade, and it is the part worth keeping. Canada's advantage in this story is not that it suddenly became bigger than the US. It is that it looked safer. And in a weather-sensitive, supply-sensitive, globally traded product like coffee, safer can suddenly become very valuable. This is especially true because the coffee market was already under stress before the tariff shock fully played out. Reuters reported that the coffee market was already dealing with weather problems in Brazil and Vietnam, and that US roasters were burning through inventories while waiting for clarity on trade policy. That means the tariff did not hit a calm market. It hit a nervous one. And nervous markets reward reliability faster than people think. That is why Canada matters here. Not because Canada suddenly became the center of coffee, but because Canada became part of the diversification logic. That is a subtler and more credible claim. Brazil does not need to believe Canada can replace the entire US market. Brazil only needs to believe that relying too heavily on an unpredictable US market is now more dangerous than before. That changes incentives. And those incentives are not just about coffee. They connect to the wider Canada-Brazil relationship, which is stronger than many people realize. Canada's own government says bilateral merchandise trade between Canada and Brazil totaled $12.7 billion in 2024, with Canadian direct investment in Brazil at $19.8 billion and Brazilian direct investment in Canada at $15.9 billion. That matters because it shows coffee is not sitting inside an empty relationship. It is sitting inside a broader commercial relationship that already has depth. That broader base helps explain why Canada could look more attractive in a moment of trade stress. Not because Ottawa had to reinvent itself, but because Canada was already a serious partner in a wider Brazil-facing economic network. And here is where the story becomes more strategic. In August 2025, Reuters reported that Brazil was in constructive dialogue with Canada to revive a Canada-Mercosur trade agreement. Later that month, Reuters reported that Canada and Mercosur formally resumed talks on a free trade agreement. That matters because if Brazil is already trying to diversify beyond one politically volatile market, and Canada is already trying to build broader alternatives beyond overdependence on the US, then coffee is no longer just a coffee story. It becomes a small case study in a bigger reordering. Reuters. That does not mean Canada won the coffee war. And this is where we need to be stricter in our analysis of the situation. Reuters also reported that Brazil still sees the US as an irreplaceable market. And later in November 2025, the Trump administration changed coffee tariffs by removing duties on coffee beans from nearly all producing countries, except Brazil. Reuters said that helped US roasters and importers, while keeping Brazil under disadvantage because Brazilian coffee still faced a steep tariff. That means the trade system did not freeze into one simple permanent reroute. It remained fluid, political, and contested. So Canada replaced the US in one specific sense, not as the world's biggest coffee consumer, not as the only important market, but as the better symbol of what exporters increasingly need from a buyer in a stressed world. Reliability. That is the stronger claim. America still has scale. Canada looked safer. America still had demand. Canada had fewer shocks. America still mattered. But Canada gained relative value because the US chose pressure over predictability. That is the reversal. And it tells us something important about global trade in 2026. The old view says power comes from size. The newer reality says power also comes from being the partner who does not panic the supply chain. That is where Canada's broader strategy under Carney fits in. This is not really about coffee beans alone. It is about how Canada is trying to reposition itself in a world where the United States is still huge, but no longer automatically trusted. Reuters has reported that Carney is trying to foster a trading order less reliant on the United States, and that Canada is broadening its economic links beyond the old North American comfort zone. So coffee becomes a useful illustration. When the US politicized one of its most important coffee relationships, Canada benefited not because it was stronger in the old imperial sense, but because it looked less dangerous to build around. That is the real Tradeconomics angle. It is the same logic we have seen in other sectors. When a dominant buyer becomes unstable, exporters diversify, trusted secondary partners gain, and the old center becomes a little less central than it was before. That is exactly what the coffee story suggests. Now, let's also be honest about limits. Canada did not suddenly become the global hub of coffee pricing. It did not displace the US from sheer scale. And the global coffee system still has many other major buyers, especially in Europe. But Canada did gain something important from the tariff shock. It gained strategic relevance inside a market that increasingly values stable buyers. That is a big deal. Because in commodity markets under pressure from weather, shipping stress, policy volatility, and fragmented geopolitics, relevance can compound. Today, it is coffee. Tomorrow, it may be another supply chain where exporters look for partners that are less volatile, less impulsive, and easier to plan around. That is why this story matters beyond caffeine. It is a small example of a bigger shift. America tried to force a market outcome through tariffs. Instead, it reminded exporters why concentration risk is dangerous. And once exporters remember that, they do not just fix the immediate problem. They start redesigning the map. So here is the real Tradeconomics take. America did not lose the global coffee market in a literal sense. It is still too large, too rich, and too important for that kind of simple story. But Trump's tariff shock may have helped expose something deeper. In fragile commodity markets, power is no longer just about who buys the most. It is also about who can be trusted to keep buying without turning every contract into a political risk. That is where Canada gained. Not because it outproduced Brazil, not because it outscaled the United States, but because it looked more predictable at the exact moment predictability became more valuable. That is the shift. Not total replacement, but a change in who looks safer to build around. And once exporters start redesigning around reliability instead of sheer market size, the old centers of power become a little less central than before. So here is the question that matters most. Did Trump's tariff war really strengthen America's hand? Or did it teach Brazil and the wider market that stability may now be worth more than dominance? If you want to stay ahead of top Cadena trade analysis and how it impacts Canadian economy, subscribe to Tradeconomics. See you in the next.